Good morning, all of you. So, coming to the next topic in financial instrument is nothing but what financial liability. So, already we discussed what is meant by financial liability. Financial liability is nothing but the liability that is a contractual obligation. So, to deliver in cash. So, as per that contract, we need to settle that obligation either in terms of the cash or in terms of any other financial asset to the another entity in future, or to exchange the financial asset or liability with another entity under condition that are potentially unfavorable, and that will or may be settled in the entity's own equity instrument. Means so company, for example, in case of convertible debentures or in case of convertible bonds are there, convertible preference shares, so at the end at the date of maturity, so company convert the respected debenture into the equity share. Means the liability of the debenture holders or the liability to the preference shareholder are settled in terms of what equity shares of the company. The best example is trade payables, debentures, and redeemable preference shares. Then, so coming to the recognition of the financial liabilities. So, financial liabilities are initially recognized at financial liabilities are initially recognized at fair value. So here the fair value is nothing but what net proceeds minus cost of issue or transaction cost of the respected issue of the respected instrument. Here the net proceeds are nothing but, if for example we took the example of debentures. If the debentures are issued at par, then net proceeds are nothing but par or face value. If the debentures are issued at premium, then net proceeds is nothing but what par plus premium. And if the debentures are issued at discount, the net proceeds are nothing but par minus discount on issue of the respected security. So this is said to be a net proceeds. That net proceeds minus cost of issue is said to be a what? Fair value. Net proceeds minus cost of issue is said to be a what? Fair value. So initially these debentures are recognized at fair value. Initially these debentures are recognized at fair value. Then coming to the subsequent recognition. So at the time of, in case of initial recognition, what the journal entry we recorded? So bank account debit, bank account credit, financial liability, either debentures or preference share, all loan notes, etc. These are all covered. So then we recognize that bank account debited, credit financial liability account, and this entry recorded initially at this amount, nothing but net proceeds minus cost of issue, and we say it as what? Fair value. We say it as what? Fair value. Then coming to the subsequent recognition. Coming to the subsequent recognition. So in case of subsequent recognition, if financial liabilities are meant for trading purpose, Financial liabilities are meant for trading purpose and derivatives or others. If the financial liabilities are meant for trading purpose or derivatives, then we have to follow fair value through profit and loss approach. We have to follow fair value through profit and loss approach. In case of others, we have to follow amortization cost approach. We have to follow amortization cost. Means subsequently, in case of amortization cost, subsequently that liability is shown at what? Amortized cost. The liability is shown at what? Amortized cost. Then coming to the amortized cost. Coming to the amortized cost, at what price, so how to recognize the carrying amount, how to calculate the carrying amount of that financial liability, how to calculate the carrying amount of that financial liability. So that carrying amount is calculated in this way. So opening balance, opening balance, and what is the interest income, sorry, what is the interest expense at net effective rate of interest, net effective rate of interest, and what is the interest paid or amount paid. So on the last day, at the time of maturity, along with interest, we need to pay what? Redemption value also. What is interest paid? So that opening balance plus interest expense minus interest paid is said to be a what? Carrying amount. Is said to be about carrying amount, and this is shown in, so this amount is required to be shown in balance sheet either under non-current liability or current liability, depends upon the nature, and this amount is transferred to statement of the profit and loss as a finance cost, statement of the profit and loss as a finance cost. And remember, if the say financial liability is redeemed at a premium in the future, financial liability is redeemed at a premium in the future and issued at par, sorry, financial liabilities are issued at par and redeemed at par, issued at par and redeemed at par, then net effective rate of interest and regular coupon rate both are same. That net effective rate of interest is changed if there is any cost incurred in future, like if the debentures are redeemed at a premium or if the debentures are issued at a discount. So those additional costs incurred, in that case effective rate of interest is altered. Okay, so this is the way how to calculate the amortized cost. In case of amortized cost approach, initially that financial liabilities are recorded at net proceeds minus cost of issue. In the subsequent period, it is recorded at amortized cost. How to calculate that amortized cost? In this way, what is the opening balance plus interest expense at net effective rate of interest minus interest paid or amount paid is nothing but what? Carrying amount. Is nothing but what? Carrying amount. So here, for example, loan note issued for $1,000. The loan note is redeemed at 1,250. The term of loan is 5 years and the interest is paid at 5.9% per annum and the effective rate of interest is 10%. And here this 5.9% is said to be a what? Coupon rate, and this is said to be out effective rate of interest. Show how the value of loan note changes over its life. So we need to calculate the carrying amount at the end of the every year. So how many years are there? So the term loan is of 5 years. The term loan is of 5 years, and what is the redeemable value? 1,250. Okay, so we need to calculate the carrying amount. So year and opening balance and effective rate of interest interest paid and closing balance. This closing balance is said to be a what? Amortized cost. This opening balance plus effective rate of interest minus interest paid is said to be a closing balance. So total, how many years are there? 5 years. Okay, so initially that loan note was issued at what price? 1000. This is what net proceeds. Generally, initially that loan notes are recognized at what price? Net proceeds minus cost of issue. Net proceeds, if the shares are, if the loan notes are issued at par, then par value is said to be net proceeds, nothing but 1000. There is no cost of issue, right? So the total initially recognized at what price? 1000. So 1000. And what is the effective rate of interest? 10%. So at 10%, so this is at 5.9%. So remember, so coupon rate is always applied on the face value and effective rate is always applied on the net proceeds, nothing but in net proceeds. Okay, so 10% on 1000, nothing but 100. 5.9% on face value is nothing but here 1000, so nothing but what? 590, right? We will calculate. So how much? 59, sorry, 59. Then closing balance is nothing but what? So 1000 plus 100 minus 59 equal to 1041. So here 1041. Then effective rate is applied on the net proceeds, 1041 into 10%, 104.1, and this is nothing but what? 59. So 1041 plus 104.1 minus 59 equal to 1086.1. So 1086. So 1086. So 1086 into 10% means 108.6. So just consider 109 and 59. Then plus 109 minus 59 equal to 1136. So 1136 into 10%, 113. So 5.9% on 1000. So nothing, always it is always applied on face value. So then 1136 plus 113 minus 59 equal to 1190. So 1190 plus effective rate is 119. Then this total amount required to, because at the end of the 5th year the closing balance is 0, right? At the end of the 5th year the closing balance is 0, means we have to repay this total amount. Then how much amount is there? 1190 plus 119 equal to 1309. 1309. So this is the one. So here on the first day, so here on the year 1, when the loan obtained, loan notes obtained, we have to write the entry. So debit bank account, credit loan notes, nothing but financial liability. So how much amount is there? 1000. How much amount is there? 1000. And the second one is how to show the what is the charge relating to the loan notes at the end of the every year. So at the end of the every year, this is the amount we have to recognize in the profit and loss account as an interest expense. A profit and loss account as an interest expense. So then in the statement of profit and loss at the year end, 1 2 3 4 5, then how to show? 100 104.1 and 109 and 113 and 119, and these are shown as finance cost. These are shown as what? Finance cost. Then what is the journal entry for this one? So debit finance cost, debit finance cost account, credit loan notes account, credit loan notes account. For example, at the end of the first year, we have to write 100. Then when the amount of interest paid, then debit loan notes account, credit bank account. But how much amount of interest paid? Every year we paid only coupon rate. So we paid what? Coupon rate, nothing but what? 59 only. Every year we paid 59. So coupon rate is only liable to pay. So this is the one. And one more thing is, so at subsequently, initially we recorded the respected loan note at net proceeds minus cost of issue. Here 1000, right? Then at the end of the first year, then it is required to be shown at 1041, and we have to shown under the head non-current liability. And at the end of the second year also non-current liability. Because why we show it under non-current liability? Because the maturity period or these obligation liable to pay after 1 year, after 1 year. So, and for the third year also it is required to pay after 1 year, means after fourth year, nothing but one more year is there. So we have to show under non-current liability. But this 1190 is required to pay within 1 year, within 1 year. So we have to show under what? Current liability. We have to show under what? Current liability. So this is this column is said to be a what? Amortized cost. So at subsequently we have to recognize the respected financial liability at amortized cost. So that how to calculate that amortized cost? So what is the initial recognition plus effective rate of interest minus interest paid? Interest paid is calculated at coupon rate. Effective rate is calculated. Effective rate is considered as an expense in statement of profit and loss. Then calculate the total amount here. So what is the total amount we paid? 59 plus 59 plus 59 plus 59. Sorry, 59 into 4. So 4 minus, sorry, plus 1309 equal to 1545. 1545. Then what is the total? Initial amount 1000. Then 545 is said to be a interest on, we also call it as what? Finance cost. We also call it as what? Finance cost. Then what is this total amount? So what is the effective rate of interest? Total 100 plus 104, 109, 113 plus 119 equal to how much amount? 545. How much amount? 545. This is what is meant by effective rate of interest. So this is the problem. Okay. 540. Then coming to the first one, a company issued 5% loan notes at their nominal value of $20,000 with an effective rate of 5%. The loan notes are repayable at par after 4 years. The loan notes are repayable at par after 4 years. What amount will be recorded as a financial liability when the loan notes are issued? So when the loan notes are issued, so here the first point is about what? Initial recognition. It is about what? Initial recognition. And he's asking at what price we have to recognize initially at the time of issuing the loan notes, right? So loan notes are generally recorded at what? Net proceeds minus cost of issue, nothing but what? Fair value. That is nothing but what? Fair value. Here the loan notes are issued at a nominal value. The loan notes are issued at nominal value. So what is the nominal value? Is nothing but 20,000 here. Then there is no cost of issue, so we have to record the loan note at what price? 20,000. Initially recorded at what price? 20,000. What amount will be shown in the statement of profit and loss and statement of financial position for the years 1 to 4? So to calculate this effect or amount required to be recognized in statement of profit and loss or statement of financial position, then better to prepare the statement or better to draft the amortization table. Okay. Then so first one, test your understanding one. So here amortization table, effective rate of interest at what is the effective rate of interest here? If you see here, loan notes are issued at par and redeemed at par. Issued at par, redeemed at par. In that case, coupon rate and effective rate both are same. But if any additional cost is there, like if the loan notes are issued at a discount, then discount on issue is said to be a cost. And if the loan notes are redeemed at a premium, then the premium is also set. So in that case, the effective rate of interest is altered. It is differed from the actual coupon rate. Okay, so effective rate is 5% and interest paid at is also 5%. Then closing balance, nothing but what? Carrying amount. This is nothing but what? Carrying amount. So how many years are there? 4 years, right? Total 4 years. So we have to recognize the opening balance. How much? 20,000. Initially that is recognized at what price? 20,000. Nothing but net proceeds minus cost of issue, already calculated as 20,000. Then 20,000 into 5%, 1,000. And interest is also applied on, coupon rate is applied on face value. That is also nothing but what? 1,000. Then 20,000 plus 1,000 minus 1,000 is equal to how much? 20,000. And here also 20,000. Then here also 1,000. Here also 1,000. And how much amount is? 20,000. And this is also 20,000 and 1,000 and 1,000. How much? 20,000. So 20,000, 1,000. These two amounts required to pay because closing balance equal to 0. How much amount we need to pay? 21,000 here. 21,000. Then so in the 4 years, so in case of statement of profit and loss, we have to show the finance cost. So here, so effective rate of interest and interest rate both are same, but remember in P&L, interest expense to be shown is nothing but effective rate of interest. How much? 1,000, 1,000, 1,000 and 1,000. Then in case of a statement of a financial position, so if you observe in the first year, this amount required to pay after 1 year, so we classify it as non-current liability. And this amount is also required to pay after 1 year, so we classify it as non-current liability. But this amount required to pay within 1 year. So after, at the end of the 3rd year, from the end of the 3rd year, we need to pay by the end of the 4th year. Means how many years are there? 1 year. Within 1 year, you need to pay. That's why we have to classify it as current liability. So 20,000, 20,000. This is a non-current liability. This is also shown under non-current liability, but this is shown under what? Current liability. And in the 4th year, the balance, there is no balance. The amount is 0. Clear? So here the both effective rate of interest and coupon rate both are same. Effective rate of interest and coupon rate both are same. Okay, this is the one. Clear? I hope you guys understood the concept of a financial liability. Then coming to the second one, a company issues 0% loan notes at their nominal value of 40,000 The loan notes are repayable at a premium of 11,800 after 3 years. The effective rate of interest is 9%. What amount will be recorded as financial liability when the loan notes are issued? So remember, when the loan notes are issued, what is the recognition criteria? For financial liability, nothing but what? This is about initial recognition. Initial recognition is made at what? Fair value is nothing but net proceeds minus cost of issue. What is the net proceeds here? So that loan notes are issued at nominal value, nothing but what? 40,000. And there is no cost of issue. If you observe, there is no cost of issue, so minus 0. So we have to recognize that what? 40,000 initially. Then what amount will be shown in statement of profit or loss and statement of financial position for the years 1 to 3? Okay, then for this purpose, better to draft what? So amortization table. Okay, so here, so opening balance, effective rate of interest. What is the effective rate of interest here? 9%. Effective rate of interest 9%, and interest paid at 0%, and closing balance interest or amount paid. So how many years are there? 3 years. And here initially we recorded this amount at what? 40,000, right? So 40,000. So 40,000 into 9% equal to 3,600. So here interest paid is at 0% is applied on face value. Face value is 40,000. So 0. So 43,600. Then 43,600. So here 43,600 into 0.09 equal to 3,924. So interest is 0. So 43,600 plus 3,924, 47,524. So 47,524 into 0.09 equal to 4277. Then here we need to pay the total amount because closing balance is equal to 0. So 47,524 plus 4277 equal to 51,801. So here, so we have to show in the 1, 2, 3. So in statement of profit and loss as finance cost, first year 3,600, second year 3,924, third year 4277. And next, in case of statement of financial position, so nothing but in balance sheet, we have to show this amount under non-current liability, because this amount required to pay after 1 year and this amount required to pay within 1 year, we have to show it under current liability. So 43,600 is shown under non-current liability, 47,524 is shown under current liability, and the balance is 0 for the third year. Balance is 0 for the third year. Okay, so this is the second one. This is the presentation relating to the statement of financial position, statement of profit and loss. Okay, just do this problem. And here first I will tell you the initial recognition. Here a company issue the 4% loan notes with a nominal value of 20,000. The loan notes are issued at a discount of 2.5% and 534 of issue cost are incurred. So then what is the initial recognition? We have to recognize that what? Net proceeds minus cost of issue. Here that loan notes are issued at discount. Nothing but the net proceeds are nothing but par value minus a discount. So par value is nothing but what? 20,000. Then discount is 20,000 into 0.025, 2.5%. That is nothing but what? 500. Then what is the cost of issue? 524. Cost of issue is 524. Then so 20,000 minus 500 minus 524 equal to 18,976. So this is what recognition. 18,976 initial recognition. Then what is the journal entry recorded? So debit bank account, credit loan notes account. So at what? 18,976. 18,970, and the remaining is common, and it means initially we have to record it at this amount. Here effective rate of interest is there, and loan notes coupon rate is there, and we apply the remaining one. Okay, so do this problem. Then coming to here, so Viking issues 1 lakh 5% loan notes on 1st January 2000 X4, incurring the issue cost 3000, and the loan notes are redeemable at premium, meaning that effective rate of interest is 8% per annum. And what is the finance cost to be shown in statement of profit and loss for the year ended 31st December 2000 X5? So here the loan notes are issued at par, but there is an issue cost. So net proceeds are nothing but here 1 lakh minus cost of issue is equal to 3000. So we recognize them at what? 97,000. Then if you drop to the amortization table, here opening balance, effective rate of interest, and interest paid, and closing balance. So how many years are there? What is the lifespan here? So there is no lifespan, just we can consider 1 year. So what is the amount to be recognized? 97,000. So 97,000 into what is the effective rate here? 8%, equal to 7,760. 7,760. And so then coupon rate is always applied on opening balance. So 1 lakh into 5% equal to 5,000. Then what is the closing balance? So 97,000 plus 7760 minus 5,000. So equal to how much amount? 99,760. 99,760. So here asking what is the finance cost to be shown in statement of profit and loss is nothing but what? Effective rate of interest 7,760. For example, what is the amortized cost to be shown in balance sheet? So then we have to consider what? So 99,760. We have to consider what? 99,760. But only asking finance cost, so answer is 7,760. Clear? So coming to this one, Wonder issued $20 million 5% loan notes on 1st January 2000 X9, incurring issue cost of 6 lakh. And the loan notes are redeemable at premium, giving them an effective rate 7%. What is the expense should be recorded in relation to loan notes for the year ended 31st December? Here expense is nothing but what? Finance cost. So then, so just we need to calculate what finance cost. So then what is the $20 million? So $20 million. So minus, so 20 million means what? 200 lakhs. So 20 million means 200 lakhs, right? 200 lakhs. Then 6 lakh is the cost. Cost of issue is equal to 6 lakh. This is the issue price, nothing but net proceeds minus cost of issue. This is the initial recognition amount, nothing but fair value. 200 minus 6, 194 lakhs. Interest expense is always calculated on the initial recognition. So 194 lakhs into what is the effective rate of interest? 7%. So into 0.07 equal to 13.58 lakhs. So 1358. Okay, so 1358. So this is the amount. Just he is asking what is the amount of expense. For example, if the question says need to calculate what is the closing balance, then better to draft the table. Then if you remember year and opening balance, effective rate of interest and interest paid, closing balance. This closing balance is said to be a what carrying amount to be shown in financial position statement. This is what amount of expense to be shown, effective rate of interest, amount of expense to be shown in statement of the profit and loss as a finance cost. Clear? So this is what loan notes related case. Then coming to the preferentials. So if the preferentials are redeemable, if the preferentials are redeemable after some period, we consider it as a debt instrument. We consider it as a debt. If the preferentials are irredeemable, then that is treated as equity instrument. So if the preferentials are redeemable in the nature, means repayable after some period, better to consider it as debt instrument. If the preferentials are irredeemable, then consider it as equity. Then based on that, we have to recognize that financial liability. We have to draft. But in case of debt, whatever the rate of dividend is there, itself is treated as a finance cost. Rate of dividend itself is treated as a finance cost, and remaining the total accounting treatment is same, just like we follow in case of previous loan notes or debentures, etc. Okay. For example, here on 1st April 2000 X7, a company issued 40,000 $1 redeemable preference shares with a coupon rate of 8% at par. They are redeemable at a large premium, which give them an effective finance cost of 12% per annum. So how would the redeemable preferentials appear in the financial statement for the year ending 31st March 2000 X8 and 2000 X9? Okay, so those are issued at what? 40,000 preferentials are of $1 each. So nothing was stated, means those are issued at par. Those are issued at what? Par. So then so what is the initial recognition? So nothing but what? Net proceeds minus cost of issue. Here 40,000 into $1. There is no cost of issue. So $40,000. There is no cost of issue. So how much amount? $40,000 is there. Then so what would be these redeemable preferentials appear in the financial statements at the end of 31st March 2000 X8 and X9? How to show it? Then same way, draft year, opening balance, effective rate of interest, and interest paid. Interest here is nothing but what? Dividend. Then closing balance. Opening plus effective rate minus interest is nothing but what? Closing balance. So we require to calculate for 2 years, right? So effective rate is how much? 12%, and coupon rate is 8%. So we have to recognize initially at what? 40,000. Effective rate 12%, coupon rate at 5%. So 40,000 into 12%, 4,800, and here 40,000 into 8%, 3,200. So 40,000 plus 4,800 minus 3,200, 41,600. Then here 41,600 into 12% equal to 4992. So those are redeemable after 2 years. Nothing was stated regarding the redemption. Okay, so just we calculate 8%. So 40,000, always coupon rate is always applied on face value. So 8 equal to 3,200. So then 41,600 plus 4,992 minus 3,200, 43392. Then, so how these appear in the financial statement, correct? So this is shown as a finance cost. In statement of profit and loss, and this is shown as non-current liability in statement of financial position. Nothing but what? Balance sheet. Nothing but what? Balance sheet. So same thing we consider in case of preference shares and in case of loan notes or debentures. Okay. This is the one relating to the financial liability. And in case of the financial liability, one more important concept is nothing but what? Compound instrument. Compound instruments. So compound instrument is nothing but the instrument which is having the both features of equity and liability. So some part of the instrument represents debt component and some part represents equity. The best example is convertible debentures or convertible preference shares or convertible loan notes are there. For example, on 1/1/2021, Excel Limited issued convertible debentures to the public. So here, at the time of issuing the convertible debentures, he clearly stated after how many years, that debentures are converted into equity. After how many years the debentures are converted into equity, that was clearly stated. And another one is how many shares are going to issue per debenture. How many shares are going to issue per debenture. So these terms are clearly stated. So if that instrument which contain both components of debt as well as equity, then that instrument is called as what? Compound instrument. Like convertible debentures or convertible bonds or convertible preference shares, etc. So means those debentures which are going to convert into equity after some period. So in this case, the main concept is, so you need to calculate the element of the debt and element of the equity. So in case of compound instrument, so two elements are there. One is element of the debt and another one is a element of the equity. So then how to calculate the individual element of the debt and individual element of the equity? Then coming to the first one, so just we need to calculate the present value of cash flows. present value of cash flows of that entity, present value of cash flows, sorry, present value of cash flows of that instrument, is calculated by assuming it as non-convertible instrument. Non-convertible instrument. So for example, 10,000 9% debentures are issued by the company. 10,000 9% debentures are issued by the company. So here, if the debentures are converted into equity share, then the rate of coupon rate is 9%. If the debentures are not converted into the equity share, then market rate of interest is nothing but 12%. Market rate of interest is nothing but 12%. In that case, this is what convertible debenture. In case of convertible debenture, how to calculate the coupon rate? First, calculate the cash flows relating to the respected debenture. So here, what are the cash flow relating to the instrument? So cash flows, nothing but what? Interest. For example, 5 years period is there. 5 years period is there. Then first year we have the interest. We need to pay interest. Second year we need to pay interest. Third year we need to pay interest. And fourth year we need to pay interest. And the fifth year we need to pay what? Interest plus redemption value. Correct? Interest plus redemption value at the end of the fifth year. If you assume it as a non-convertible debenture, remember this one. These present value of cash flows are calculated by assuming that instrument is a non-convertible instrument. Then, so what is the discount rate to be considered? The discount rate is nothing but the rate of interest or coupon rate of that instrument if it is not converted into equity share after some period. So if it is a non-convertible debenture, then what is the coupon rate in the market? So if it is a convertible, what is the coupon rate? 9%. If it is a non-convertible, what is the coupon rate? 12%. At 12%, we calculate the present value. Then we calculate present value of the cash flow. So present value of cash flow is nothing but what? Cash flow into present value factor and the total. So then we calculated for every year and the summation is said to be a debt element. Summation is said to be a debt element. Then, so in case of a compound instrument, so from the value of compound instrument, if you reduce the debt element, then we get what? Equity element. We get what? Equity element. Clear? So in case of compound element, there are two parts are there. One is element of the debt, another one is equity element. Another one is equity element. So remember for convertible instrument and non-convertible instrument, which is having high rate of coupon rate. Non-convertible instrument has high rate of coupon rate. Convertible instrument has a low coupon rate. For example, in the exam, two coupon rates are provided and we are unable to ascertain the rate of interest or the discount rate at which we require to calculate present value. Then just consider high rate, because we need to calculate present value of the cash flows by assuming that instrument as non-convertible. In case of non-convertible, high rate of coupon rates are there, high rate of interest are there in the market. Okay, clear? Then, so how to calculate the debt element? By calculating what? Present value of the cash flows of that instrument is calculated by assuming that it is a non-convertible instrument. It is a non-convertible instrument. Clear? So then after calculating the debt element, if you reduce the debt element from the value of compounded instrument, then we get what? Equity element. Then we get what? Equity element. This is what? Compound instrument. So for example, here Convert company issues a convertible loan that pays interest at 2% per annum in arrears. The market rate is 8%, being interest rate for an equivalent debt without conversion. So this is the market rate of interest if it is a non-convertible. This is market rate of interest if it is a convertible. The loan of $5 million is repayable in full after 3 years or convertible into equity. Discount factors are there at 8%. Split the loan between debt and equity at the inception and calculate the finance charge for each year until the conversion or redemption. Clear? So here we need to calculate compound value of compound instrument is equal to what? $5 million. $5 million, right? Nothing but what? 50 lakhs. 50 lakh. Then we need to split this amount into debt and equity. Then how do we split? First we calculate debt element. Debt element is nothing but what? Present value of cash flows of the instrument at market rate of interest if it is non-convertible. So then how many years are there? 3 years. So then year and cash flows and discount rate at what is the coupon rate if it is non-convertible? 8%. Then present value of cash flows. So 3 years are there. Year 1, 2, 3. Year 1. Generally here cash flows are calculated at original coupon rate if it is convertible. So because it is a convertible, what is the coupon rate? 2%. Then this 2% is applied on the $5 million, right? So then 50 lakh into 2% equal to 1 lakh. Equal to how much? 1 lakh. Equal to how much? 1 lakh. And those are redeemed. So those are redeemed after 3 years. Those are ready. If it is a non-convertible, those are redeemed after 3 years. Then after 3 years, we have to redeem what? 1 lakh interest at the end of the third year plus the value of the debt. What is the value of debt? 50 lakh. Correct? We assume that while calculating the debt element, we assume that that instrument is a non-convertible. So we need to pay how much amount? 51 lakh. Then discount factors are already provided here. So 0.926 and 0.857 and 0.794. Okay, so 1 lakh into 0.926 equal 92,600, 85,700. Then 51 lakh into 0.794, 40 lakh 49,400. Then what is the amount? So 926 plus 85,700 plus 40 lakh 49,400 equal to 42 lakh 27,700. So this is the element of debt element. Then what is the equity element? Equity element is equal to value of compound instrument minus debt element. That is nothing but what? 50 lakhs minus 42 lakh 27,700. 7 lakh 72,300. So this is what element of equity. So 7,72,300 is said to be element of equity, and that is the balance. Okay. So this is what compound. Then what is the journal entry to be recorded? What is the journal entry to be recorded here in this case? So first we receive the amount, right? Then while receiving the entry, debit bank account, credit debt liability, and credit equity liability account. So total 50 lakh. So 42 lakh 27,700 is debt, and 7 lakh 72,300 is what equity. This is the entry to be recorded in case of compound instrument. In case of what? Compound instrument. Clear? So that was clearly stated. We have to record it initially. So initially it was recorded at what? Fair value. The fair value is nothing but the present value of future cash flows of discounted using the market rate of interest for non-convertible debt instrument. This is about what? Debt recognition. So this is nothing but the present value. Element of debt. Next, equity is equal to loan proceeds less calculated liability. Nothing but what? So total loan proceeds are 50 lakh minus liability, nothing but debt element, 7,72,300. We have to pass this entry. Debit bank account, credit debt liability, credit equity liability. Subsequently, so remember, in case of debt element, we follow the amortized cost approach. In case of the debt, we follow the amortized cost approach, but equity portion is always same. Every year, equity portion is always same in the statement of financial position. But coming to the debt, we have to apply amortized cost, and based on that, we need to calculate what is the what is the carrying amount at the end of the every year. But remember, while applying the amortized cost at the end of the maturity, the value of debt should be equal to the loan proceeds, nothing but 50 lakh. Value of debt should be equal to the loan proceeds, nothing but 50 lakh. For example, if you observe, already calculated that one. This is the what? Amortized cost approach. Then we start with 42 lakh 27,700. So if you round it off, 42,28. Then effective rate is 8% and interest is 2%. Then what is the last one? 55 lakh, 50 lakh is the matured amount, and here is the closing balance, because that amount, that liability is not settled in cash. This amount is going to be converted into equity. That is what is the concept of convertible bonds or convertible debentures. Clear? Then coming to the problems. On 1st October 2000 X3, Bertrand issued $10 million convertible loan notes which carry a coupon rate of 5% per annum. The loan notes are redeemable on 30th September 2006 X6 at par for cash, or can be exchanged for equity share. If it is redeemed for cash, then redemption value is at par. A similar loan note without conversion, what is the coupon rate? 8%. The present value of $1 receivable at the end of each year based on discount rate at 5%, 8% can be taken. But remember, while calculating debt element, we have to consider higher rate. Nothing but if the instrument is assumed as a non-convertible, what is the coupon rate? That coupon rate is considered as discount rate, nothing but 8%. Nothing but what? 8%. Then first we calculate what is the value of instrument. దాంట్లో నుంచి we have to reduce what element of debt. So $10 million, $10 million, $10 million is nothing but what, 100 lakhs, right? 100 lakhs minus debt element. What is the debt element? Present value of the cash flows, nothing but what, here cash flows at, what is the coupon rate, 5%, and present value factors are calculated at higher rate, nothing but we assume that it is a non-convertible, then what is the coupon rate? At that rate we calculate the discount rate, then present value of the cash flows. Then how many years are there? 3 years. How many years are there? 3 years. Nothing but 2000 x3 to x4, x4 to x5, x5 to x6. Clear? 3 years. Then 5%. So then what is the interest? So 100 lakhs into 5%, 5 lakhs. So for the second year also 5 lakh, but the third year we need to pay par value. So if it is paid in cash, then we have to redeem it at what, par value. Par value is nothing but what, 100 lakh plus third year interest 5. So 105 lakhs. 105 lakhs. Then what is the coupon? Present value factor 0.93, 0.86, 0.79. Then so 5 lakhs into 0.93 equal to 465. Then 5 lakhs into 0.86, 430. Then so 105 lakhs into 0.79 equal to 82,95,000 plus 430, 465, 91 lakh 90,000. This is what debt element. But in the question not asking the debt element, they need what, equity. So from the value of an instrument, if you reduce the debt element, 91 lakh 90,000, what is the amount of debt? So 100 lakhs minus 91 lakh 90, how much? 8 lakh 10,000. So 8 lakh 10,000 is said to be a equity portion. 8 lakh 10,000 is said to be what, equity portion. So these remaining problems already we did. Then coming to the convertible loan, another question is there. Here we need to calculate the two parts, equity and debt element. So what is the value? An equity, an entity issued 3,000 convertible bonds at the start of the year 1 at par. They have 3-year term and face value of 1,000 per bond. That means 3,000. So 3,000 into 1,000, nothing but what, 30 lakhs. Interest is payable in arrears at 7%. If it is convertible, then the coupon rate is 7%. Each bond is convertible at any time up to maturity into the 250 common shares. When the bonds are issued, the prevailing market interest rate for similar debt without conversion option is 9%. Without conversion option is 9%. The relevant discount rate factors are shown below. Then, so first, how to divide into debt and equity? First, we need to calculate the element of the debt. Element of the debt is calculated by using the present value factor. Then here, then cash flows and discount rate at, so 9%. Then present value of the cash flows. So total how many years? 3 years. So what is the 30 lakhs is the total value into what is the coupon rate? 7%. So 2,10,000. So 2,10,000. For third year also we need to pay interest along with redemption value 30 lakh, 32,10,000. 32 lakh 10,000. Then discount factors are already provided. Then so 2 lakh 10,000 into 0.914 equal to 1 lakh 94 940. Sorry, 1 lakh 91 940. Then so 2 lakh 10,000 into 0.837 175 770. Then 32 lakh 10,000 into 0.76 24 58 860. So plus 175 770 plus 191 940 28 26 570. This is the element of the debt. Then equity element is equal to total value. So 30 lakh minus debt element 28 26 570 equal to 173 430. So the option is D. Element of debt 28 26 570 and equity element 173 430. Clear? This is about what convertible or compound instrument. These are the problems relating to the financial instruments. I hope you guys clear about this one. Okay. So financial asset already discussed. Okay. Thank you.